Hello and welcome to CMC Markets on Friday the 25th of January and this quick look at the week ahead beginning the 28th of January. But before we get to that, I have a quick preview of the week just gone, and it's been a bit of a mixed bag. FTSE 100 has had by and large a fairly disappointing week, respecting the trend line from the peaks that we saw in the middle of the summer, finding progress a little bit difficult to sustain anywhere above the 7,000 level, and we've started to drift back down again. But contrast that to, say for example, the performance of the German DAX, and it's been a slightly more positive picture, despite the fact that we've seen some fairly disappointing economic data out of Germany as well as the rest of Europe. I think one of the key factors thus far, in terms of the DAX moving higher, I think has been a slightly more dovish tone from the European Central Bank, which has, I think, to a certain extent kept a cap on the euro. And in essence, I think there's also been a technical break above the 11,000 level in the DAX, which is proving to be fairly supportive of the index, and could well see us move back towards the 11,500 level. If we also look at Asia markets, there's been a slightly more positive tone there as well. The Nikkei 225 has closed higher for the third week in succession, and again that's on the back of a fairly dovish Bank of Japan. But I also think there is a little bit more optimism around China-US trade, despite the fact that Wilbur Ross, the US Trade Secretary, said that China and the US were miles away or miles apart on coming to some form of trade agreement by the end of this month. And there is a meeting at the end of this month between Chinese Vice Premier He and senior US officials with respect to trying to thrash out some form of agreement going forward. If we look at the performance of the S&P 500 this week, it's been largely unimpressive. We haven't really moved significantly higher, but we found the downside fairly limited, and it's going to be a big week next week, I think, for US earnings as well. Been a bit of a mixed bag this week, but next week we've got the big three of Apple Q1 for earnings for Q1, Facebook Q4, and Amazon Q4, and I'll cover them in a little bit more detail. But there are a number of other key events coming up this week, which could well dominate the headlines. First of which is the Brexit debates kick off with respect to Plan B, and the pound's had one of its better weeks this week on rising optimism that a no-deal Brexit is becoming much less likely. Now, obviously, I think investors think that it is becoming much less likely because of a quorum of MPs in the House of Commons are looking to pass an amendment next week that will be tacked on to a bill which says that if there is no deal approval for a Plan B by February the 26th, the House of Commons must vote for an extension to Article 50, and that would prevent the government from running down the clock to the 29th of March. Now, there has been some softening around the edges on some parts of the Brexiteers that they may accept a time-limited backstop, but there is no evidence whatsoever that the European Union would accept that condition. So we still remain where we were a week ago, and that's basically one of three options: an extension to Article 50, which will have to be approved by the European Union, a revocation of Article 50, or a no deal, all of which are in the hands of MPs in the House of Commons. Nonetheless, the pound has moved higher. We've moved above the 200-day moving average. We haven't unequivocally closed above it, and as such, it's still likely that we could see that there's an awful lot of nervousness around about 132, anywhere near 132 in the range highs that we saw from September, unless there is a significant moving of the goalpost going forward. So that starts on the 29th of January. We've got a Fed meeting on the 30th of January. And I think this will be particularly instructive in light of recent comments from various Fed officials who've been talking about the need for a pause in the US rate hiking cycle. Now, if we look at the way the dollar's performed over the course of the last few days, certainly I think the market seems a little bit unconvinced about the fact that the Fed will pause this year. It's unlikely we'll get a rate rise in March, but it certainly doesn't rule out a rate rise in, say, for example, June, September or December. Weekly jobless claims came in at the lowest level since 1969, but US data at the moment is going to be significantly unreliable because of the government shutdown. So it's going to be very, very difficult to get a handle on how well or how badly the US economy is performing over the course of the next few weeks, simply because we will not have any data being collated for that. Now, we do have non-farm payrolls coming up on Friday. That's one of the few numbers that may not be affected by the US government shutdown, but certainly I think some elements of data collection might be. So even while we may get a number, it may not be particularly instructive, and I think that's going to be the key for markets going forward. Will we see a significant market reaction to the payrolls number, given that the data may be a little bit unreliable? Nonetheless, I think in terms of the Fed meeting and on-farm payrolls, there will be two events next week that will definitely drive the direction of the dollar. Now, US officials, as I say, will be hindered by the fact that they don't have visibility on US economic data, and that I think will keep them with a fairly neutral bias for rate hikes going forward, and ultimately I think keep them very neutral and probably mean that a March rate hike is nowhere, it won't be considered. Now, obviously the January payrolls number is going to be compared and contrasted to the December one of 312,000 and the wage growth number of 3.2%. That payrolls report ticked every conceivable box in terms of how well the US economy is doing. This payrolls report probably won't do the same thing. It's likely to come in much lower than that, but as long as wages hold up fairly well, I think it's quite likely that the dollar will remain fairly well supported. We also have the latest European Union CPI numbers. Now, in the wake of the ECB rate meeting and the dovish change to guidance by the European Central Bank in terms of the growth risks have shifted to the downside, I think the inflation numbers are going to reinforce the fact that core inflation within the euro area remains very, very weak. We've broken below this trend line from the lows in euro dollar, from the lows in the end of last year, but we haven't as yet broken below the 112.80 level. I think as long as we hold below 114, then I think it's quite likely that we will still maintain the downside bias and revisit these lows of around about 112. 111.85. We've also got manufacturing PMIs out on January for January on the 1st of February on Friday. We've got a whole host of data out on the Friday, so it's going to be quite busy from that point of view. But the Fed meeting will be instructive, as will the US employment report. So I said I would move on to Apple, Amazon and Facebook, and with that I will certainly do that. And if we look at Apple's share price, that's been on a significant downward slant for quite some time now. One of the main reasons for the underperformance in the Apple share price was a decision at the beginning of this month to downgrade the outlook for the quarter from $92 billion of revenue to 84. Now that's still a healthy chunk of change, but ultimately I think there's concerns about the slowdown in China, lower demands for its iPhones. You look at the Q4 revenues of 63 billion. I think Apple's had a slightly poor quarter. I think they're overreaching in terms of price point, and that would suggest that it's quite likely that unless the Apple's share price gets back above this 160 level here that I'm highlighting here, these peaks from the beginning of the month through here, there's the profit warning. We've pulled back some of that, we filled the gap, but we haven't moved back above 160. If we can't get back above 160, there's a good chance we could trend lower through the lows that we saw at the beginning of the month and down to levels last seen back in 2017. If we also look at Facebook, again we've seen some significant declines and a bit of a rebound there as well, but they've been, the last 18 months again have been hard going for Facebook, and again here big resistance level again around about the 160 level for Facebook, and that's going to make it, I think, very, very difficult for the share price to recover going forward. And last but not least, it's our old favorite Amazon. We look at the share price here, again we've seen a decent rebound, and in particular I think with respect to the sales or the revenues numbers are going to be of particular interest, because Amazon has had a fairly decent performance over the past 12 months, turning out some really decent profits, largely as a result of its cloud and advertising business. Its share price did plunge in Q4, along with the rest of the tech sector, and it did issue a little bit of a downbeat Q3 earnings update, which means that despite the really strong performance that it posted in its holiday period, where it sold a record number of items, I think in terms of the revenue number, that's going to be particularly key in terms of, did it achieve those sales as a result of heavy discounting, or did it achieve some decent numbers as a result of some fairly decent turnover. So again here, big resistance around about $1,800, $1,800 there. If we can get through there, then we could go quite a bit higher. But again, what's instructive about all three of these is significant resistance areas from the peaks that we saw October and November. We haven't been able to get back above them. If we get a decent earnings performance from the tech sector next week, then the S&P can resume its upward move. If we can't, then we could roll over and head back towards the downside. So a lot is resting on next week's tech earnings numbers from Apple, Facebook and Amazon, 29th of January, 30th of January, 31st of January. So that's it for this week. Thank you very much for listening. It's Michael Hewson talking to you from CMC Markets.